Hello everyone, welcome to This Day in Europe. Germany's automotive giant Volkswagen sees a seismic drop in first half performance. Operating profit for the second quarter plunged 29% to 3.8 billion euros. That prompted the company to cut its top-end annual profit margin guidance by 1.5% to 5%. Volkswagen cited tariffs, high restructuring costs, and a shift to lower margin electric vehicles as major contributors to its weakening results. Volkswagen took a 1.3 billion euro tariff hit due to sweeping U.S. import duties. To resolve this, CEO Oliver Blume is considering major investments in U.S.-based production, particularly for Audi and Porsche, to reduce exposure to American tariffs. Market analysts see the results as a canary in the coal mine for European automakers. Some investors welcome a potential 15% U.S.-EU tariff deal, noting that auto stocks surged after Japan secured such terms with Washington. Now, the EU still sees a trade deal, quote, within reach with the United States and is scrambling to finalize the 15% deal modeled after Japan's arrangement to avoid harsher 30% rates set to begin August 1st. But analysts remain cautious about the auto sector, citing a host of structural challenges: a strong euro, sluggish EV adoption, and surging Chinese competition from brands like BYD that continue to pressure auto profits across the board. And Volkswagen certainly isn't alone here. Stellantis, the company behind Jeep, Peugeot, and Fiat, recently reported a preliminary net loss of 2.3 billion euros in the first half due to 300 million euros in tariff-related charges, suspended production, and costly restructuring efforts, despite shipping 1.45 million vehicles, including Rams. The company is also dealing with recalls in a large number of cars. Volvo Motor Group and others are in a tight spot as well. Volvo CEO called the U.S. tariffs, quote, absolutely unnecessary, and warned of collapsing margins unless trade policy shifts before August. EU automakers are lobbying Brussels to negotiate immediate relief using promised U.S. investments as leverage. European trade officials are exploring options such as import mechanisms that essentially reduce tariffs on EU-made cars exported from U.S. plants, benefiting firms like BMW and Mercedes-Benz that already manufacture in the States. At last check, Volkswagen stock moved higher today in Frankfurt. The company plans to slash up to 35,000 jobs by 2030 and double down on EVs, where margins remain challenging. As for Stellantis, shares are higher in Milan, but down about 33% year to date. Investors are waiting for the July 29th report to see how the company rearranges operations in these very precarious times. Overall, the broader auto sector is sending a clear message. Tariffs are not just cost, they mandate strategy shifts. Whether Europe can strike a fair deal is really crucial here. A 15% tariff compromise could ease immediate pressure, but companies warned that without structural adjustments, profits will continue to contract. As the U.S. deadline nears, investors and policymakers want to see if European automakers can rebound on policy promise or buckle under the global cost of protectionism. From Arnhem, Netherlands, I'm Anita Sharma for A News.